Do you have a limited liability company? Well, in this video, I'm going to talk about how do you pay yourself from your LLC. All right, let's get started. Okay, so when it comes to limited liability companies, there's a lot of confusion out there about how do I pay myself from my LLC? And the truth is, it can be quite complex when it comes to paying yourself out of your LLC. And if you get it wrong, you could possibly leave yourself open to an audit. So what am I getting at? Well, when it comes to a limited liability company that you've set up, let's say here's your business LLC. Now that we have to draw a distinction here between a business LLC and an investment LLC when you're paying yourself. So I want to focus on the business limited liability company, and then we'll tie in the investment LLC here in just a moment. So with a limited liability company, there are essentially 4 ways in which you can pay yourself out of your LLC. The first way in which you can pay yourself is a salary. Okay, so you're familiar with what a salary is. This means that you're going to put yourself on W-2 income. So you're an employee of that limited liability company. So you're working for it and you're taking money in exchange for your services. So that's why I said this LLC here is a business. So this business could be an auto repair shop that you structured as a limited liability company, or maybe you just sell donuts. You're a baker. Whatever it is, you're running an active business. Now you would not engage in taking a salary if it was a passive activity. So if it was a rental limited liability company that had a rental property in it, then the salary does not make sense. That's why I said this applies to active businesses. The second way in which you can receive money or pay yourself from your LLC is what we call a distribution. Now, what is a distribution? A distribution is a payment to the member, okay, of the LLC for being a member. It's like a dividend for a shareholder in a corporation. It recognizes the fact that this is your company and you're getting a return on your investment into this company via the form of a distribution. So distribution payments are those checks that are cut by the LLC to the members of the company. Distributions do not go to any other parties. They only go to owners, whereas a salary can be paid to anyone who is working for that company that you've put on payroll. The third way in which you can take money out of a limited liability company is through a loan. So here's where you can, lend yourself money. And if you wanted to do a loan, there's no problem with that. Just make sure that when you loan yourself money that you're documenting the fact that you've made this loan to yourself. So it doesn't look like a disguised salary or a disguised distribution. Now, this is important from an audit standpoint as well as an asset protection standpoint. Because if somebody was suing you and they saw a number of loans that were being paid out from the company to yourself, they may say, well, these were disguised distributions, and that could change what they could collect in a lawsuit. So you have to be very careful to put together a promissory note, the normal things you would do if you're putting together a loan. Now, the fourth way in which you can pay yourself out of an LLC is what we call a reimbursement. So an example of this might be, hey, you're at a lumber store and you need some new supplies for your office because you're going to do some remodel work in the office. So you put them on your personal card. Maybe you spent $800 there. Well, when you get back, you then jump into the office. You write down what it was for, the $800, fill out a check, give it to yourself, and right in the memo line, you put reimbursement. So the reimbursement, what you're doing is you're not giving yourself a salary. You're not giving yourself a loan or a distribution. You're stating that you, as the individual, either employee or owner of the company, you spent money on behalf of the business. And now the business is just making you whole, reimbursing you for this. So those are the 4 common ways in which you can pay yourself out of a limited liability company. But the next part here is really important about how you go about determining which is the appropriate for you in your situation. Okay, so what do we have to look at then? We have to look at the purpose of that limited liability company. So I'm going to give you 2 examples here. One is the active business LLC, and the second LLC here is an investment LLC. Maybe it holds a rental property or it holds a brokerage account. So when it comes to these options here, these 4 different options on using those and paying yourself out of an LLC, the first option here is salary. That only applies to an active business. It would never apply to this type of LLC down here that holds passive assets. You're just not working for these for your rental property. We don't want to turn your rental business or your passive activity into an active activity. So we're not going to pay a salary from this type of business activity. Now, if it was flipping, that's a different scenario. So salaries only apply to active businesses. But here's where people get into problems who set up LLCs, not understanding the distinction here. In order to pay yourself a salary out of your limited liability company, you have to do one of two things. You either have to elect to treat your LLC from a federal tax standpoint as an S corporation or as a C corporation. So you have to choose either S corporation tax status or C corporation tax status when you set up that LLC. You're wondering, why is this? Well, when you have a limited liability company that's treated either as a partnership, which means there's two members there, or a disregarded entity, you're not entitled to put yourself on payroll. The IRS will not accept it. In fact, what they look at you in that scenario, they'll say, hey, you're a sole proprietor with respect to that LLC. So you're not able to put yourself on a salary. In fact, if you tried to do it, you're probably going to get audited once they figure it out. So when it comes to limited liability companies, if you want to pay yourself a salary, you need to make sure your LLC is treated as an S Corp or a C Corp for federal tax purposes, and then you can go about doing that. That is the only way that it'll pass. So salary is important. There's lots of benefits that come from having an S Corp or a C Corp and being on salary, but that's not the purpose of this video. So distributions. All right, distributions work with either this entity or this entity. Generally speaking, with a passive LLC, that's how you're going to take your money out of that LLC. That's how you're going to pay yourself, is you're going to issue out a distribution. And you'll probably do the same thing with your active business. Now, the thing about the distribution, when it comes out to you, either here or here, generally speaking, it's not subject to employment taxes because it's not considered to be active income. So when you pay yourself a salary, it's subject to 15.4% employment taxes on those payments. So yes, some of you may not want to pay yourself a salary out of your business because you don't want to pay that extra employment tax. However, if you're running an active business and you're an S Corp or a C Corp, you're going to have to pay a salary to yourself, a reasonable salary to justify the time you're spending on the business and the money you're receiving. Again, if you don't do it, you're going to open yourself up to audit. Now, if you're not set up as a C or an S Corp and you think, well, great, then I can't pay myself a salary, so I won't be subject to that 15.4%, think again. You're wrong, because in that scenario, as I told you earlier, if I have this active business here and it's a disregarded LLC or it's treated as a partnership, then every dollar I receive from my LLC is going to be subject to employment taxes. So that's why there's a strong rationale for people who are running active businesses through limited liability companies to elect to treat their company as an S Corp or a C Corp, so they have some control over how much of their income they receive is going to be subject to employment taxes. All right, so generally speaking, distributions are not subject to employment taxes. They're going to be distributed down to, and you're going to save on that. And so that's a great way to pay yourself out of an LLC. The loan. The loan is another technique. It can be applied here or it can be applied here. If I have a passive business, generally, I'm not going to take loans out of my LLC unless I was involved in a lawsuit and there was a charging order on my interest. So loans are typically going to come from the active business side rather than the passive business side. And then the reimbursement, it goes both ways. Because we all know that if we have a business, be it a passive business or it's an active business, and you're out there and about town and you have to stop and pick something up for your business and you're not using your business card, well, then you're entitled to a reimbursement. So those are the four ways you can take money pay yourself out of your limited liability company. And again, depending on how they hit you, salaries are taxable, distributions may or may not be taxable, loans, not taxable, reimbursements, not taxable to you. Guys, if you learned something here and you liked the video, be sure to smash the like button. And if you want to learn more about how Anderson can help you in creating a limited liability company for your active business and making sure you get the tax structure set up the right way, hey, look in the show notes. I have a link there. You can click on it and set up a free strategy session with us where we can delve into your situation and give you some concrete ways to save on taxes. Take care.